Herd mentality is a very important thing to human beings. We travel in packs. We gather together. We must do what everyone else does. We simply follow along because if someone else is doing it and having success, then it must be good for me as well. Just like lemmings, we also fall off the cliff at the same time too. The top stocks today seem to be a part of everyone's portfolio. You came here for the truth, so let me unveil that for you. Today we're going to go into issues such as what are the hedge funds buying? What are the hedge funds selling? We're going to take a look at the deficits. We'll look at debt. We're going to look at so much more. Let's begin. It's going to be one of those jam-packed crazy episodes. Beginning with this, the 50 stocks that matter most to hedge funds, but I want to single out 5 of them, and that is Facebook, Amazon, Microsoft, Alphabet, and Apple. There are more, of course, on this list, and you could see that for yourself. I know the font is pretty small, but you can get the link in the description. But essentially what we're looking at here are the typical names ending up on the top of the list. This is something that I bring up frequently. I try to bring it to you as often as I possibly can. This information is as of pricing is as of May 15th, but the holdings are as of March 31st, 2018. You'll see this here, the number of funds with stocks as the top 10 holdings. Okay, so very important to see that these hedge funds here are collecting the exact same stocks. All of them are doing that. It's very important to be able to gather this information together, see who's buying, who's selling. Now, the 50 stocks representing the largest short positions here are looking at similar names that we've covered before, whether that's AT&T, Intel, Walmart, Nvidia, and many others on this list. I think that a lot of the shorts are really in trouble right now when it comes to the oil, gas industries, because now they are starting to turn around and have really been hurting those who have been shorting it. So I'll be able to cover that more in just a second here. Largest net increases in fund popularity based on the change in number of shares held by funds. Number of funds changing portfolio allocation during the first quarter of 2018, the most popular increases. Look at that. Facebook, Microsoft, and other tech companies like Salesforce, information companies. There are a few names on here that I found interesting. Now, when you look at Facebook, it was really in trouble for a little while there, and I think a lot of these hedge funds and things are starting to look at it as an opportunity to buy in. I don't necessarily recommend that to happen, but that's really the case. So you'll see that for yourself as part of this chart here. The most heavily shorted stocks have recently outperformed their peers in most sectors, and that is right here. Energy, clearly been one that has outperformed the expectations because oil was subdued for quite some time. We saw it around $30 a barrel, then it was sitting at $40 a barrel, up and down for this long period of time, and recently has moved over $70 a barrel, and Brent actually peaked over $80 a barrel. So that surprised a lot of people, and because of all the geopolitical tensions and everything else that's been taking place, it's been pushing this higher and higher. And you've seen gasoline prices with this great disparity in between that and the price of crude oil, making these certain individuals very rich. Now, this here is the second quarter to date equity return by sector. The most shorted is far outperforming the rest, and that's interesting because you think that everybody's going in this direction. They all hate this one thing, but then it turns to actually be able to be a good performer for some people who take the opposite bet. Largest net decreases in fund popularity, and you'll see this here. Typical names: Amazon, Apple, Alphabet, and others. Of course, there's Citigroup in here and everything else. So this is another chart that I just wanted to show you here. The most popular decreases. I think a lot of people are starting to see certain stocks starting to notice the fact that, hey, I've made a lot of money on this particular stock, and I think it's time to start selling off some of the shares and buying some other depressed things. They're starting to put a lot of money into the energy market. Of course, people are still buying, like Warren Buffett, for example, still making huge purchases in these tech companies. There's no doubt about that. The debt and deficit would expand significantly by 2028 under several scenarios. You can see that there are, whether it's the Goldman Sachs, whether it's Congressional Budget Office, they are all looking at these different, possibilities for where we have come from and where we will head into the future. Taking a look at the numbers, it doesn't really matter. It's bad in both ways, whether it's the debt on the right side, whether it's a deficit here on the left side. We are getting worse in every scenario. I mean, it doesn't surprise me. I know it doesn't surprise you, but for some people, seems to be quite an issue, but it's business as usual. Our baseline budget deficit projection, this here just showing you a more accurate prediction here, zooming in, whether it's the CBOs, whether it's Goldman Sachs. Look, take it in the middle. We're getting worse. This is as a percentage of the GDP, looking at what, minus 6% here. It's going into the territory where they can never get back at it. I mean, they're not going to be able to grow out of it. It doesn't matter. If you achieve 4% growth consistently, which would be, extremely good for the US, they still can't grow out of it. Factoring in inflation, factoring in everything that's happening today, and you realize, hey, what's going to be the future here when we are at supposedly this really, crazy highs? The stock market has been gaining since March 2009. The fake unemployment numbers are showing this beautiful scenario, and still you can't grow. The GDP numbers look dismal when you actually look at the real GDP numbers, not what is presented to us. And it's quite unfortunate. Okay, I want to get into real estate here for a moment, looking at this, how it interconnects with interest rates, right? Fear of missing out may persuade Americans with an eye on buying a home to hurry their decision before it gets more expensive. But while demand shows few signs of teetering, jumps in both property values and borrowing costs will test the market's durability. That's really the issue that a lot of people in this industry are not really factoring in. Yes, the prices are going up. Yes, borrowing costs are going up, but it's not an issue. I don't really see how that all works. Home sales are now hovering near expansion highs, though momentum has been kept in check by lean inventory that's fueling an acceleration in prices. That is the issue in some areas where you see, for example, they have typically detached homes all around, and there are only so many. So there are people moving into this neighborhood that are trying to get into the neighborhood that are ultimately, they are, let's say, kept at bay because they physically can't get in. There's not enough homes to get in. Yeah, that's certain areas, but there are a lot of condominiums coming up that allow, hundreds and hundreds of units per condominium, and that sort of spikes the available inventory. That depends on the area, of course. So let's look at some of the issues here in chart form. This is out of Bloomberg. Dude, where's my house? Lack of U.S. inventory persists even amid ideal selling conditions. You'll see this on the chart for yourself if you're interested to look at this. Inventory of previously owned homes here. You can see the decline. Lowest in records to 1999. So that is a factor that will push up prices. That's pretty clear. And looking at the good selling conditions because of high prices, going to the highest data since 1992. Now, that's not necessarily the fact that it's at the highest in this regard that's necessarily a bad thing. Not really. It just shows us where we're at. It doesn't, when we break records in certain things, just because the price of something may hit a record high, that doesn't mean it has to come down tomorrow. Not necessarily, but we have to understand when things become too heated, okay, or too undervalued. Less attractive. High prices, rising interest rates chip away at U.S. housing affordability. So we are looking at this level here going back into the financial crisis territory. The affordability has definitely become a big issue because when we have to factor in what the average individual is paying for their gas today, their electricity prices, their food prices, and so on. At the end of the day, they only have so much money left over. But what if their mortgage, which they're going to have to pay, or their rent prices are accelerating even faster than all of this? At the end of the month, they're left with nothing. They have to go into debt. So that is the problem that a lot of people are not factoring in. They're going to have less and less savings today. We're only talking about a couple percent savings for the average American. I mean, that here should be a very big, issue that's never going to be discussed, but it should, because we need to have savings. We need to get out of debt, and we need to be able to buy the things that we like, whether they're liabilities or assets. We should have the money available for that, but that's not what we do today. Everybody simply goes further and further into debt. They use their home as an ATM. Very important. They refinance their property. They're able to use home equity line of credit. They have all different schemes in order for you to get your money out. Have no fear. Now, I want to change the pace for just a moment, cover just two things that I wanted to add to this video. I did a video previously talking about this issue here, where you look around the US and you see different income levels. You see what different disposable income for the average individual. And this is something, when I saw this chart here, I needed to bring it to you, and it's from a website, AXIOS.com. AXIOS.com. They have a really good interactive chart. So you can see that this is the share below poverty, and you'll look around the map here. You can see they're using mostly light colors. We don't end up going into that 30% mark that often. So I'm going to put my mouse around here, and you'll look around. You can see the different areas if you want. Below the poverty level is, for example, in this area of California, 18%. Now, if I put my mouse over and I click on this button, share below the ALICE level, and ALICE is Asset Limited Income Constrained Employed ALICE Threshold, okay? You get a very different picture. Very different picture. So I'm going to be able to put my mouse around here, and you'll see that a lot of people, unfortunately, are unable to make ends meet, despite the fact that they don't go into the category of poverty. And that is something that needs to be addressed, because you have individuals who go about their daily lives, they're going further into debt, they're working 2 jobs, they're working 3 jobs, they're working temp jobs, but they are not able to buy what they want. They're not able to do what they need to do. They're not able to make ends meet in terms of food. They are on food stamps. They have some sort of social assistance programs that they're taking advantage of at this time. They have, a disability, whatever it might be. There's so many programs available to people that they are using at this time. We see those numbers are near highs at this time. And that's not showing up on the statistics. That's why I really like this, because it gives us a good idea of how things are really going. I mean, you see 51 million households, if I remember correctly, 51 million households are actually part of this. So imagine how many people right now are struggling. At the same time, you have some people, a small group of people, who are doing very, very well. So that's all. And for my friends in Canada, I wanted to show you this. Who spent what? A look at federal program spending since the 1940s. You'll see this here. The budget for 2017 has accelerated far beyond what we have ever seen, and it's just going to go higher and higher and higher. The situation in Canada is the same as the situation in the US, the same all around the world. We need to have more deficits. We need to have more debt. It's just the way it works. If you start to reduce the amount of debt, reduce the amount of our deficits, you will bring the system down. So they can't have that, and ultimately we will see a continuous increase in that. Now, if they want to collapse the system into something else, they can do that as well. Of course, that will be the case. When? I don't know. We'll have to find out. That's all for this video. If you found it informative, please give me a thumbs up. Again, I went all over the map, but really I wanted to show you what people are buying, what people are selling, how the debt looks, how the deficit looks, and of course, how that factors in with interest rates, with borrowing costs, real estate, and margin, and everything else that people are getting themselves into these days. That's all. If you found the video informative, I know that you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. All you got to do is go over to Amazon. There's a look inside feature, which will allow you to flip through the pages of these books to see if you like them. Take care.